All right, good evening. I hope you're having a wonderful day wherever you are. Today, we are covering a very interesting asset class. A lot of traders I know either fear it or love it in equal measure. That would be crude oil, traded by a lot, especially those who like the commodities market. But before we go far, I am your host, Jesse. And as usual, I'm joined by Rufas for yet another episode of Bullish Banter. How are you doing, Rufus?
I'm doing fine. I think it's a bright day, so
Yeah.
I'm ready for this.
Excellent. Now, previously we had spoken about the Hong Kong and the Chinese stock market, and I know we talked about it quite briefly, but never really, delved deeper. That would be the Caixin Services PMI, which came out. That would be earlier last week, around Thursday last week, Wednesday.
Yes.
It came out very solidly above the projection or the consensus of 52.5. Is the Chinese economy now, a walking giant?
Well, I believe so, and this is basing this from what I'm seeing happening with the Chinese equities. So the top indices, the China A50 index, is on the verge of breaking 1-year trend line on the upper side. The Hang Seng A50 index is also on the verge of breaking an upper trend line. So the two indices are indicating some good growth. They have only gone up since the start of the year. So when you compare the opportunity presented by European and US indices, some of which are trading near their all-time highs, there's a huge difference considering that Chinese indices have been on a bear market since COVID. So for them, about 4-year bottoms, they are just bouncing from there, from the lows we saw in January. So it seems that there's more opportunity for upside for Chinese equity indices compared to what we are seeing with the European as well as US counterparts.
Very interesting. I know last year there was a very, very worried, I think, sentiment in the markets, if you are following it, whereby there was some degree of deflation in the product pricing in the economy, while the other side of the pond, they were basically having an increment in cost of living due to other factors and not necessarily driven by fuel. Do we expect now, given most of the suppliers, I want to believe, of Chinese market are part of the OPEC members, OPEC and OPEC plus members, is the tide now shifting from American, supply of oil into the global markets to OPEC, or we might see some degree of tug and pull in the next couple of months?
Well, I would like to begin by mentioning that China has been very busy in terms of oil exploration. So as earlier as last month, they were able to identify new oil deposits in the Bohai Sea. So in terms of being energy sufficient, China is really working hard to make sure it can find its own oil. But then in terms of supplies, if you look at the deals China has been making since COVID, they are mostly what I would describe as unilateral deals. First and foremost with Russia, then later on with Iran, Iraq, and those deals are basically helping China secure long-term deals with stable prices. So it's something that China has been really committed to, and shifting away from the open market to the open market basically means that the economy is expecting to see much more stable prices, which is healthy for economic recovery.
When you say stable, what price ranges are we talking about for oil?
Well, if you are in a bilateral agreement, you're able to agree on a pricing that maybe extend 1 year, 2, 3, 4, 5 years, compared to in Kenya, how we buy oil today. By the time we are buying the next shipment, the price has already changed, and that exposes us to the volatility in the market. But then when you have a bilateral agreement with a different country that supplies you with oil, you are able to agree on a price beforehand.
Interesting that you mentioned that. I believe that was on Monday, if not the end of last week, that would be around 8th of April, the US production has reduced by around, I think, almost 100 million barrels from 12 point around 3 on a daily basis or monthly basis for March to something to around 12 thereabout. And that is why I was wondering if they have been making all this exploration as well as still maintaining their deal with the major players within the OPEC markets. Might we see now the decline of American supply of oil, and therefore they are controlling, influence on the price of oil? Hence, why we are seeing almost 1 to 2% increment in crude oil, at least on a weekly basis.
Well, for the better part of last year, the global crude oil prices were being controlled by the US. On one side, the US oil production had really gone up to record highs. And on the other side, there was the issue of US President Joe Biden drawing oil from the strategic petroleum reserve. So during that period, even if the OPEC were going for more and more oil output cuts, they were not having the desired effect of leading to a rally in oil prices. And in so doing, US having control of oil prices continued depreciating, moving down and down. And as a result, the US was able to make significant steps in its battle against inflation. Remember, inflation peaking at 9.1% in 2022. Then 2023, towards the end, the US was able to hit a record of 3.0% before the reemergence of inflation. So this is coming as a result of what we are seeing with the OPEC countries getting deals, and the major linkages are now aligning up.
Excellent. You have mentioned something very interesting, and I think I like to tie it politically. I'm sure you have seen this interview of the Guyana president, whereby he was defending himself against BBC inquiry regarding their fossil fuel exploration. And I know it's not just Guyana alone, which is led by President Ifran Ali. There are other countries within that seaboard who are also involved with the exploration, which I know companies which you have spoken about before, like Occidental, ExxonMobil, and the rest, are heavily invested in or acquiring exploring companies. Do you expect that to add to America's influence, at least in the coming months, even if their production is declining, at least to impact the price of oil?
Well, I would say the American explorers have been busy, like really busy in terms of oil exploration across the world. But then what we are seeing is regulations, international community getting in between their exploration efforts. So one of the key leading impacts or inferences has been coming from the climate change agreements. And at the same time, we also have the various policies agreed by the West that are basically impacting these companies. A good example is Chevron, which pledged to exit Myanmar in 2022. And this was mainly as a result of the country basically breaching the democracy rules. As a result, the West implemented what we call sanctions on Myanmar, and as a result of that, Chevron had to exit early this year. So we are seeing these companies really going out of their way to find new supplies of oil, but these rules and regulations regarding climate, as well as democracy or any other foreign policy, impacting these companies individually.
Excellent. Interesting. Now, given I think you already mentioned it, that democracy will really play a big part in whether a private company would invest commercially in a certain region. Back to the heart of OPEC nation, Saudi Arabia, Middle East in general, and obviously Scandinavia. The recent escalation of tensions, to say the least, a lot has been driven or attributed to with the spike in oil. Is it that the tension now people are paying to it because there is a real likelihood of a war, or it's just speculators looking at several factors in the economy and therefore putting all their bets that the price of oil will go up?
Well, I would say, with the exemption of Russia, the foreign policy tools used by the US are more effective to smaller countries. So, for instance, we know, like, there's a lot of allegations about, let's say, things that don't go well with the US foreign policy happening in China, happening in Saudi Arabia, and those guys don't get sanctions. So, as long as they're in strong control of a particular sector, those guys don't get the same sanctions as smaller countries. So, while a country like Myanmar might get sanctions as a result of the coup that happened in their country, we don't get such policies applied to bigger or strategic economies like Saudi Arabia. So I expect the collaboration between the US and Saudi Arabia to continue forward as usual. And in this case, I think Saudi Arabia is looking forward. So if you look at the trends in industrialization, where a majority of manufacturers are taking their firepower, a lot of them are going to China, Asian countries, others are going to India. And it basically means that demand for oil is moving in that direction. So for economies like Saudi Arabia, they are more interested with integrating with the economies where production is going. And this is majorly in the BRICS countries.
Okay. Maybe I'd like to your take on something. I know ideally the Ukraine issue started, that was literally the main fundamental factor, at least driving volatility and price action to a common direction. Do we expect, maybe with the talks of peace, with the talks of continued maybe lack of ceasefire, will it likely still be something a lot of investors will be following? Given if you look at some of the reports I was sharing with you from Bloomberg to JP Morgan review on oil prices, they expect a tighter price, at least to the level of maybe 100 thereabout, especially for Brent and West Texas Intermediate Index. Will the political narrative still maintain a significant influence on those who are participating in the crude markets, or it will die down at some point?
Well, geopolitics has been the major key driver in oil prices. And looking at the global economy and what has been happening, 2022 through to 2023, this is when a lot of economies were just coming back from COVID. So even the job market had not recovered, companies had not recovered. So it was bittersweet. Demand wasn't that strong. But then from what we are seeing, the global economy is strengthening. And with the strengthening of the global economy comes higher demand for oil. So that's one key driving factor that investors are observing right now. So besides this, when you look at the geopolitics, they are majorly affecting supply. So when the Russia-Ukraine war started, it was majorly happening in Ukraine, and nothing was flowing back to Russia. But then, when you observe the recent developments that have happened in the last 3 months, the Ukraine soldiers now are able to send drones that attack Russian oil infrastructure. So far, at least 13 plants have already been hit by Ukrainian drones, and that is affecting a key source of oil supply in the market. So that's a key development that investors are currently trying to price in. The other key thing I believe is big in the markets right now is the Hezbollah attacks along the Red Sea. So these attacks have made it very expensive to ship products, including oil, along the Red Sea, where a lot of ships have had to now divert all around Africa. And that has brought about two factors in oil. On one side, deliveries are taking longer, at least 10 days. And on the other side, for the insurance companies that cover these ships or shipments, they are now pricing in a higher premium. So insurance for shipping has gone up. And as a result of that, it has added a premium of $2 to $3 per barrel on oil prices. So those factors combined together are leading to even higher prices. And from what we are seeing with both of the wars, Ukraine being bold enough to bomb Russia, And now the other Arab countries joining in to support Hamas are trying to decelerate the war. But Israel now, on the other hand, trying to take it forward. I don't think there's de-escalation. It's only escalation we are seeing in both of the wars. And as a result, that adds a premium on geopolitical risk, which increases the price of oil. So there is a good chance that oil prices might be trading between $80 and $100 per barrel for the rest of the year.
Interesting that you mentioned that, because I am looking at the chart of gold, and I think there is something which is quite interesting. Perhaps I think I'll share the screen just to highlight it. Is gold sort of our for guidance, whereby whatever happens to the demand of gold, I'm sure you've seen the reports from People's Bank of China. You have seen the reports from, I think it's Polish Bank, which are the leading central bank, rather, which is the leading purchase of gold in plenty in tons, over 100 tons on a month-on-month basis. Is the continuation increment in price of gold sort of a warning that as much as things are looking okay, there is something off in the air, and you might want to sort of hedge your positions accordingly with the commodities market?
Well, I agree with you on this one. There's quite a lot of red flags that are currently very clear and obvious in the market. For instance, if you look at a company like NVIDIA, which reported 22 billion revenue in the last quarter of 2023, in the very first quarter of this year, the company has gained in terms of valuation by at least $1 trillion. And that's massive. You can compare $22 billion versus $1 trillion in valuation. So in that case, it basically screams of a highly speculative market. So if you look at stock markets globally and try to understand which ones are close to all-time highs, then the first choice you will take is American equities, SP 500, the Nasdaq, Dow Jones, all close to all-time highs. The Nikkei 25 index also close to all-time highs. If you look at the London FTSE 100, it's close to all-time highs. The Spanish IBEX close to all-time highs. So with all these stock markets being at close to all-time highs, including the Indian stock market, the Nifty, you realize that the markets have become heavily speculative, mostly because there is excess money in the system. So when markets are at these levels, investors start getting afraid or concerned about potential reversals in pricing. So in such a scenario, you will find that an investor may still be holding some position in a company like NVIDIA, but now they take on some exposure in gold to hedge against that risk. So that's on one side. On the other side, there's the monetary policies and how they are reemerging this time. So while a majority of global economies have been able to fight inflation and get close to their targets, it's a very small number of economies that have achieved this number. So we saw the Swiss National Bank cutting interest rates last month by 25 basis points because for them they had achieved the inflation targets. But then for the ECB, if you look at the UK, the US, inflation is resurging and moving on higher. So when you realize that inflation is coming back and interest rates might have to stay higher for longer, then in this case, you find that investors are looking for a safe haven. So on top of that, we have seen BRICS countries have been buying more and more gold, perhaps in preparation for a new currency or some form of hedge. But one thing that they are absolutely sure about is that if things start going bad, a commodity that is hard to find or mine might be a better store of value compared to highly speculative assets that can potentially be printed out of thin air.
Excellent. There are a couple of points where I think maybe it would be interesting to just reiterate. First of all, highly speculative. I think was it maybe a couple of years back, one of the legendary investors, I think it's from Citadel, I'll have to counter check. He said that the market is becoming uninvestable. Is it investable? Given a lot of players are in the markets and they are basically trading and not really looking to hold maybe for a year or so. They just want to capitalize on price action, especially during the Wall Street bets eras. And of course, congratulations to Reddit now, which is a fully publicly listed company. And I think recently, Jamie Dimon as well, CEO of JP Morgan Chase, has alluded to the same, that the market is becoming too speculative and making it hard to invest. Do you think that is the case, or maybe um, the strategy? I think that was a very interesting comment I received, or rather looked from that, picked up from that comment. The strategy maybe they have been using is losing money in the current market conditions, and note that the markets are uninvestable.
Well, what we are seeing is these banks are getting their models broken. So in traditional finance and the way we have been studying finance over time, we know that any time central bank has accelerated rate hikes and tried to tighten policy further, it eventually slows down the economy, increases unemployment, and eventually leads to weaker stock market. But then for a majority of the banks that were betting on that, their models were broken by the reaction we saw in the markets. So it's weird. Like, for instance, if you look at the US economy, the dollar is currently really strong against other currencies. At the same time, what we are seeing in equities, they're also going up. Gold is going up. So what is going down? If you look at bond yields, they're also going up, giving investors record returns. So a majority of the traditional models that we learn in finance have been broken. They're not working anymore. And that may explain why they are saying that the market is uninvestable.
Excellent. Now, to the second point, there is a lot of money in the markets. And I believe part of the reasons why the Fed has been very aggressive on tightening would be, or rather hiking the rates, would be to reduce liquidity in the market. Are we likely to see not only higher for longer, but maybe the Fed maybe pausing on their this policy stance of targeting 2.5 and maybe looking at other data sets in the economy just to give, let's say, the investors and consumers some cushion by maybe a small hike of 0.25? I know Kashkari has been very hawkish on, even if possible, we can go ahead and do another maybe 0.25 basis point. Are we likely to see them breaking from the tradition of very tight monetary policy just to cool down the other sectors, especially on the commercial real estate, before proceeding with maybe the higher for longer sentiment?
Well, from the trend we are seeing at the beginning of the year, Fed members were projecting at least 5 rate cuts this year. And within 3 months, now that we are on the 9th of April, this has reduced to 2. So now we're expecting 2 rate cuts. And some of the Fed members are already suggesting that there could be 1 or even 0 rate cuts. But then, from the moment they switched last year and decided that their policy is going to be data dependent, and looking at the trends we are seeing in inflation, I think the persistently high inflation is changing their minds. And at some point, they will have to come out clear and say that this inflation is quite strong and resurgent, and we might have to hold rates higher for longer. But then, on the question of inflation targeting, Jerome Powell has been pretty clear that the number one thing he needs to rein on is on inflation expectations. So he needs to rein on this and make sure it drops back to the 2% target, and then wait until the policy is implemented, get the US inflation back to 2%. So I don't think they're changing the target, but on the data-dependent approach, it seems more likely that inflation might continue being a problem, especially considering that this year, since the year started, oil prices have been up 19% before they raised some of that gains from Friday last week down to 16%. But still, a 16% increase in crude oil prices is bound to have an effect on consumer prices.
Okay. As we wrap up, on your side, maybe what would be the metrics you'd be looking at while you apply on oil to, let's say, make maybe a trading the market? What would be some of the checklists of fundamentals or political aspects to aid you in your investing or trading journey?
Well, first of all, I would be very concerned with the US because it has become the biggest producer of oil. So I will be looking at the inventories in the US with a key focus on the trends, whether the trends are generally increasing in terms of production or reducing. So second, I'll be closely following on the OPEC plus countries. I remember the last time oil prices were trading at around $135 per barrel. Uh, at that moment, a lot of countries in the OPEC were not following the regulations and they started producing more because the prices were really high and good for them. So in this case, I would be following the OPEC countries to see the numbers, how much they're producing versus how much they are supplying in the market. On top of that, I'll be following the global demand. This is the GDP across different economies, with key focus on the industrial or manufacturing sector to see whether manufacturing is rising because this tends to translate to higher demand. So on the geopolitical front, I will be observing the current developments in Israel-Hamas war as well as the Russia-Ukraine war. So any signs of de-escalation might be the key factors that eventually lead to lower oil prices. But as long as there is any form of escalation in the two wars, then that might add a premium on oil prices.
I think for me, an overview of what is happening to the oil stocks itself, especially on their when we get the earnings report. I'd be very much interested to look at what is their rate of return so far up to now, and if there is still some plans to increase their production capacity to meet the growing demand, especially from a resurging China. And definitely, it is a political year, so I know US will really try as much as possible to keep inflation at a rate that is possible for the Democrats to campaign. So, in addition to what you have just said, I'll be looking at the specific oil producing companies. I think their stock price is also a reflection of what is happening in the industry. So, I think that can be a good indicator for myself. Perhaps maybe as we wrap up, any closing remarks, at least for this session?
Well, in the short run, I'm pretty bullish. So I'm expecting a range between $80 and $100 for the better part of this quarter and the next. So this means that anytime we see oil tracking back to 80 might be a nice area to focus on as a demand zone. And of course, if we get to 100, we might consider looking for exits as we expect supply to expand as a result of high prices.
Thank you very much. For those who have not traded before and would like to begin their journey, I'd highly encourage you to open a demo account that you can use to practice, engage the market, familiarize rather with the price action and how it works. Of course, we do continue to educate and offer any necessary information to aid your trading and investment journey, be it on our socials, FXPesa from YouTube, Instagram, Telegram, and TikTok. I've been your host, Jesse. Hope you enjoy. Until next time, feel free to ask and add your questions. Adios.